Hey there, it's Mike Wise, CMG Home Loans, with your weekly mortgage update. And this will be the last one until December. We're going to skip next week for Thanksgiving. So happy Thanksgiving to all of you guys out there. Hope you have a safe and happy Thanksgiving weekend here. So let's get into what's happened this week in mortgage news. So let's go to our vibe board and give you a update as to what's going on. So the jobs report, this is one thing that we were waiting for. That was Thursday, and the numbers came out a little bit better than expected as far as the jobs numbers are concerned. They were at 119,000 jobs for the month there, and month of September. So keep this in mind that this is for the month of September, and so we're kind of backwards looking here. We're trying to catch up. And they were expecting only 60,000 jobs in the month of September. So that was a lot better than what expected. But the unemployment rate went from 4.3 to 4.4%. Now, it almost hit 4.5%. There was just a rounding error of like 0.1%. It would have pushed it up to 4.5%. That would have been a little bit bigger news. But I think that, at the end of the day, they adjusted the, let's see here, September. So they adjusted the 2 months prior down further, which were not great months anyways. And then October was a pretty bleak month. But you can see this has been the jobs, and they're clearly going down. They did have a little bit of a rise up there, but at the end of the day, we have to figure out, are these numbers actually accurate? Now, let's take a look at what ADP came in for the month. So when you look at ADP, this was the month of October, right? So this is 1 month later. There was only 42,000 jobs that were created. And so that's kind of what the market has been looking at. They were a little nervous with the numbers coming out the way that they did with the jobs report and it being a little bit stronger, but the unemployment rate going up to 4.5% or 4.4%, almost 4.5%. That was a little scary, and then their adjustments down for the previous 2 months. So the problem here is that we don't get any of the September. We don't get the October, and we're not going to get the November numbers until after the Fed meeting on February 10th. So we're not going to get those numbers, and so the Fed is not going to have those numbers to be able to help them make the decision. So let's noodle on this just a little bit further here, because I want you to see what has changed over over 24 hours here. But you can see this is the chances of the Fed actually lowering the Fed funds rate. So after yesterday's activity, NVIDIA reporting all their numbers, it was basically, this is a month ago. They were 100% going to change in December with the rates, and then it went all the way down. This is 1 week ago. This is yesterday. 40% chance of the Fed actually lowering the Fed funds rate, and as of this morning, after digesting all of the numbers from yesterday and the reports and so forth and where everything's going, there is now a 75% chance that they're going to have a rate cut in December. So it's very fluid. Now, why are they doing this? What's the issue that they're looking at? So the inflation, I think that they feel like the inflation, even though it's at 3%, they want to get it down lower, but I feel like they think that's under control. I don't think that that's anything out of control. The gas prices are coming down. That's going to drive some of our the goods and services that we consume on a day-to-day basis. That's going to drive those prices down a little bit. You've already seen some stuff coming down. But at the end of the day, what they're looking at here, I think, is the unemployment number, right? So the jobs, and you can see this is the unemployment rate, and what we just said is that it went up. So right here at the end, it's starting to go up, but look at this trend. It's starting to go up, starting to go up here. Now let's go back and look at a couple different times. These are kind of weird times, but if the unemployment rate goes, it goes fast. So look at this number right here. So it starts to trend up, and then all of a sudden it shoots up, and it's a fast thing that happens in the economy, and then it's a slow roll down. And this is the pandemic, so this is a little bit different, but basically you can see that it shot up there. So the question is, and after each one of these is a recession. When we have recessions, the interest rates usually go down because they want to spur the economy and get it going again. So I guess what I'm trying to say here is that the Fed has to stay ahead of this curve and make sure that they lower the Fed funds rate to keep the economy going and strong. So you don't want to get too far behind, and that's why I think there's pressure on them to lower the Fed funds rate. And I do think that that is why you started to see this go up again to 75% chance that they have a rate cut in December. So we'll see what happens here, but let's keep on going with some of our other news here. So this is the forecast for 2026. The National Association of Realtors. And I think what I want to tell you here is basically they've been stuck, the transactions have been stuck at 4 million, but the NAR, National Association of Realtors, forecast a 4% price growth in 2026. Now that's nationwide. It's not here in California specifically, but at the end of the day, there's a couple of things in here. So mortgage rates, they are saying they're going to be at 6% in 2026. So not much of an improvement. We're 6.25-ish. We can get down to 6% in some instances, but it's not a huge benefit here if the mortgage rates stay here, right? Now, there's also new home sales up 5%. Existing home sales, they're going to be up 14% in 2026. So that is good news for us. Unemployment rate, 4.4%. That's where we are today. So if we start to see things, the unemployment rate go up a little bit, we start to see the interest rates come down a little bit, you're going to start to see more activity. But existing home sales, they're still like pretty anemic. But I'm going to get into something here a little bit here. Builders cutting prices, and home buyers are responding. There's some pretty big concessions from the builders that are going up. There's the job losses. Here's a interesting chart. So if you think prices, they've gone up here as of over the last, this is from the last 5 years, I think, on this. Yeah, 5-year home price change since COVID. Look, up 45%, up 50% in Texas. All the blue areas, up 50%. The green areas, up 60% or more in those areas. So the prices have gone up. I don't know that they're going to come down because we have an increasing, I got to get to that number, but an increasing number of people. The population is going up. There's still a lot of people in this world are trying. In fact, here, let's see if we can get to the number. This is, we're still selling homes like it's 1995, right? 1995, 3.8 million houses were sold. 2024, 4 million houses. That's not very much, and the population is growing significantly here. The single-family inventory is lower than 1995. So there's not enough houses to kind of get people into those homes. Now, what I want to show you is the cost of waiting on this. So this is a house right here in my area, right? If you wait 1 year, this is going to cost you, it's going to cost you $30,000 if you don't buy it today, and your payment is not going to change. So you're going to give up 4% appreciation. If you bought it for $889 today, it's going to be $924 in a year from now. And if you did that, your payment is basically going to stay the same because interest rates might come down a little bit. And you're talking about a minuscule difference, but you're going to give up equity, and it's going to cost you. Let's go down here, and we can go into these numbers. I can show you these more in detail. Your cash to close is actually going to go up. So at the end of the day, right now, if you have the opportunity to buy a house and you can afford it, it is probably a good time to do that because you can most likely negotiate some seller concessions, buy down the interest rate, and get a lower interest rate today. Save money on the rate, save money on the purchase because it's a lower purchase price, and at the end of the day, you're going to get appreciation of a minimum of 4% probably over the next year, because the inventories are not going to go up very fast here. So let's see here. So let's look at the current markets. Just go back to as far as where interest rates are today, this morning, and where they're headed. Let's see here. So we're up 11 basis points on the mortgage-backed securities here, and that's good news. That means that the interest rates are starting to come down a little bit, and the yield on the 10-year Treasury is down 4 basis points. That is good news as well. We're starting to trend down. We're right here. We're trending down. We can break through this 25-day moving average, and if we can break through that 25-day moving average, we may get down to the 4% level. So at the end of the day, there's not a lot of changes here, but this is a perfect time during the winter months, November, December, January, to get out there. If there's a house listed and you can buy it and you want to buy that house, it is a great time to try and get out there and buy it. This is Mike Wise. This is your weekly mortgage update. I hope you have a great Thanksgiving, and we will see you in a few weeks.